Hope everyone is doing well. Overall, really interesting day. So on the daily chart, we gapped down for the second day in a row. We gapped down yesterday and rallied, and today we gapped down as well. And we tried to rally. However, around the middle of the day, the bulls lost control and the bears sold off into the close. And the one thing I mentioned was that I thought today would be, let me go to the 5 minute chart. My thought today was a couple of things. So you can see here, we gapped below yesterday's low. And I'm going to make it like this so it's easier to see. But you can see we broke below yesterday's low right here, this blue line, on the first 3 bars of the day. And my thought going into the day was we had a gap down in 3 consecutive bull bars. The 3 consecutive bull bars increased the odds that the day was going to be either a trading range day or a bull trend day and not a bear trend day. The reason for that is typically whenever you get a strong rally on the open, a strong bull rally on the open, it weakens the chances of the day remaining or becoming a strong bear trend day. So in other words, if we fall below 1, there's probably buyers somewhere below. Bar 1, gap down. It's a good bar for the bulls, but because of the gap down, the odds are the market is going to have at least a small second leg. Therefore, if you are bears that are selling above bar 1 are probably at least going to see the market go sideways or down. So if you're buying above bar 1, I think that a lot of traders will be pretty quick to exit if it doesn't race up. 2, decent bull bar. Buy the close bar, probably going at least a little bit higher, but it's a small body compared to the prior bar. Probably buyers below 2, scaling in lower for at least a second leg. The first target is the low of yesterday. 3, a bull bar closing on its high. Reasonable by the closed bar, but the issue is you have a big sell off and a big rally near resistance, yesterday's low. And because of that, you know that the market is probably going to go sideways fairly soon. There's also an 80% chance that you will see a minor reversal on the open, and there's a 50% chance that you'll get a major reversal on the open. Bar 4 tested yesterday's low, sold off. So we have 4 consecutive bull bars and a bear doji. Probably buyers below the doji, but like I said, we have a strong rally. We could easily sell off all the way down here before bulls come back. So this rally is a bull leg in either a bull trend or a bull leg in what will be a trading range. 4 is a break below, 5, break below bar 4 and 3. Big enough surprise on the way down that there's probably sellers above. If you're a bull and you bought the 3 close, what would you do with 4 or 5? Well, you can see the traders that on 5, they got out at the high close of 3. So some bulls buy the close, disappointed 4, and during the sell-off, what did they do? They sold out alongs back at the 3 close. 6, a bear breakout. So now we have 3 consecutive bear bars, but we have a tail below 5, tail below 4, tail below 5, and a bigger tail below 6. Probably buyers below, scaling in lower. But now we have a big up, big down, confusion, probably going sideways. Bar 7, a doji, you can see bulls bought all the way down towards the open of the day. Probably going to get back to the 3 close. So it's reasonable. If you're a bull, it's reasonable to buy the close of 3 if you're willing to buy more lower. And I suspect on 7, you had a lot of traders that bought up here, scaled in, and got out break even during the 7 rally. So a lot of traders, if you think about it, a lot of traders are not going to be So they're not going to be that interested in buying above 7. Why? Well, it's 3 consecutive bear bars. And the bulls that bought below 4 are probably going to make money. So if you look at here, if you're a bull and you buy right here, you know there's bulls buying the 4 low and scaling in. And look what happened on 6. Bulls buy the low of 4, which is 52.75. And the high of this bar went to 52.75. So if you bought the low of here, bar 4, and you bought more here, you bought more on the way down, this bar 7 allowed you to get out break even at the 4 low. Another way to think about it is if you're a bear and you sold below 4, some bears would move their stop to break even during 6. And the bears that did that got stopped out during 7. So either way, most traders will not buy above 7. They'd rather wait to see. It's buying in the middle of the trading range, and probably we could easily pull back a little bit lower. 7 is a bad signal bar, but it's a double bottom in a trading range day. So I would not be surprised if we rally from the 7 low. And then 8, a bull bar. You can see a lot of bears that sold below 4 or 5 or 6. They were disappointed 7, and they quickly started buying back shorts on the 8 open. So as soon as 7 closed as a bear bar and the momentum started to dry, everybody started buying. Bulls started buying to get long. Bears started buying to exit shorts. And then 8, decent bull bar, but it's a little bit of a surprise. Probably buyers below 8 scaling in lower, which is why traders bought the open of 9. And 1 through 4 is a strong enough rally that the odds favored at least a second leg up. So reasonable to buy the close of 8, reasonable to buy the close of 9. If you're buying the close of 9, you're buying a possible 2-legged trap, a rally up to 4, a pullback to 7, and then a second leg up to 9. 9, is it buy the close? I think it is. But if 10 is a bear bar closing on its low, something like 4, where it closes, let's just say, on its low, it's reasonable for bulls to exit. But probably buy the close going at least a little bit higher. Targets, moving average, the 25 low from yesterday. And then 10 is a bear bar. It's disappointing bar. It's not a great bar for the bears, but it's bad follow through for the bulls. So if you're a bull and you bought the 9 close, how are you feeling on 10? You're clearly disappointed. And if you're disappointed, you may look to exit break even. So traders that bought the 9 close or anywhere may get out below 10, or some bulls will wait and see if 10 or 11, in this case, if 11 is a bear bar closing on its low. And then 11, it's a bear bar, but it failed to close below 10. So probably a pullback, and the market's going to have at least a small second leg up. Some bears, they sold the high of 8. They sold the close of 8, the high of 8, or anywhere up here. They're using this pullback to try and buy back shorts at a lower price. And then 12, bad high 1. We triggered the high 1 above here and sold off. It's an inside. And let me just see. Okay, yes, it went above the high and sold off. So it's for the bears see a bad high 1. They sold above 11. The bulls, look at the 9 close. Bulls buy the close of 9, disappointed 10 and 11, and they used 12 to buy back their longs, or excuse me, sell out of longs. 13, bull breakout, closing above the past 2 bars, almost closed above 10. Decent sized bar, but here's the problem. It's 3 pushes up, 1, 2, and 3. So if you're a bull, do you really want to be buying above a high 1 here, or buying above a doji 12? And do you want to stay long when this bar is not a big bull bar and it fails and it's pausing at the moving average? And the fact that it's a possible wedge top, 1, 2, and 3. So for the bulls, they'll be quick to exit, especially if the bar closes on its low. 13, bear bar closing on its low. Middle of a tight trading range over the past 4 or 5 bars, probably buyers below scaling in lower. But if we start to get 2 or 3 bear bars, we could sell off all the way down to the 7 low. So it's reasonable to exit longs below this bar. And if the next bar is a bull bar closing on its high, traders can look to buy again. 15, High one buy, but top of a tight trading range, right under the moving average. Most traders probably better off waiting to see if the market is going to break above the moving average before looking to buy. 16, a good bar, but a failed breakout above 12, 11 and failed breakout above 13 and 14 could not close above the moving average. Most traders better off waiting for consecutive bull bars. We have a wedge, 1, 2, 3, but it's possible the wedge got reset on 9, which means 10 is the first push, 13 is the second, and 16 is the third. So to me, if I'm a bull, I'd be very quick to exit longs up here. And if I am long, my stop is probably below the 15 low. I'd be worried that if we trigger below 15, we could sell off down to here. There's bears that sold the 6 high and the 7 high, and they scaled in higher. And you know that those bears probably are going to make money. So if I'm a bear and I say I sell the 7 high, betting on 3 bars down, probably sellers above 7, and I scale in higher. Let's say I scale in above, let's pick a bar. Let's say 9. I sold here. I sold more on the 9 close. Look what happened on 11. It sold off and allowed me out at break even. And you can see 15 almost tested the break even price. So what do you think is going to happen? Well, I think at some point soon, the market's going to sell off and allow all of these bears out. Trading ranges, when everyone agrees the market's in a trading range, I'm going to skip ahead for half a second because it paints a really good picture. When everyone agrees that the market's in a trading range, this kind of a sell-off, it's super strong, looks like it's going lower, but everybody looks at it and says, yeah, it's probably going lower, but I don't know, this whole day looks like a trading range. Maybe, and if it is a trading range, the bears should be disappointed. Well, if you're a bull and you bought anywhere over here and you bought more lower, like down here, or even right here, notice how this rally let all of those bears out with a pretty small loss or even a profit on the trade if they scaled in. That is just classic trading range price action. So 17, another bear bar closing on its low. Now we're starting to get decent selling pressure, tight bull channel. So first reversal down, still probably going to be minor, but for me, if I'm a bull, I would certainly exit longs in knowing aggressive bears will sell. 18, another high one buy. So we have a new high on 17, pullback, and a bull bar on 18 closing on its high. Probably going above 17, the 18 bar range. But to me, this could easily fail and we could reverse down. And 19 failed to close above the 17 high. So it's a double top. Some bears, they sell below 17, stop above 17, worried that it's a wedge, 1, 2, 3. And they don't want to get stopped. They're worried that if the market breaks above the 17 high during 18 or 19, we could get a measured move up from the 11 low to the 17 high. So a lot of bears, they use a very tight stop, and they sold more above 18, trying to prevent the bulls from breaking above 17 and triggering the stop for the bears. So we have a lower high on 19, good for the bears, and it's a second entry short. And the second entry short is forcing bears to sell lower on the second entry. That's another good sign. Typically, when you have a second entry buy or second entry short, if the second entry, in other words, this low 2 right here, so we triggered a short here for the wedge, and the bears have another attempt to sell. If it's allowing the bears to sell at a higher price, that typically means that that it's a trap. So I'm trying to find an example. It would be similar to, I'll point an example out in a minute, but either way, whenever you get a second entry or another signal bar that's next to a prior signal bar, and it's allowing you to sell at a more advantageous price, you always have to wonder if it's a trap. 19, bear bar closing on its low. I would definitely get out of longs below 19. It's reasonable to put a stop above 19 as well. But to me, with 17 being very close to the 19 high, I would just put a stop above the 17 high. But for always in traders, it's a short below 19, betting on a couple legs down. And you can see in one bar, what did I talk about down here? All the bears that sold. Eventually, all the bulls gave up the hope that this was going to be a bull trend, and everyone agreed that it was going to be a bear leg in a trading range. And when everyone agrees that this is a bear leg in a trading range, the market will sell off rather quickly and allow all of those scale in traders out. So the bears that sold here, the bears that sold the 6 high, they sold more below bars, they sold more above bars, clearly made money. Now 20 is a bear bar, but it closed above its midpoint. So why? You have to ask yourself, if 20 is such a good sell the close bar, why did traders buy the close right before the bar closed? So bulls started buying and bears started buying back shorts. That's a sign that something is wrong with this bar. 20 is a surprise, and it's a big enough bar that the market's probably going to have at least a small second leg down. But to me, 20 is a big red flag. It's telling you that the market's probably in a trading range and not going to go that much lower. And then 21, a bull bar. So the bulls that bought the 18 low and scaled in lower made money. Bears, they sold the pullback from 20 and they made money. And I want to say one thing. See this sell off all the way down to 63? Try to figure out how to buy and make money. It's almost impossible. So if you buy anywhere in here, you buy the 57 low, you scale in lower, you're almost destined to lose money unless you do something crazy. You buy and just keep buying all the way down. But who's going to really do that? And I think one of the most important things traders have to realize is being able to assess, can the opposite side make money? So what I mean by that is, in here, if you've noticed for the past 20 bars, the first 20 bars of the day, I've been talking how both the bulls and the bears can make money. Just like how Al says in the trading course that 90% of the time, bulls and bears can make money. 10% of the time, it's very one sided. This is that 10%, and it doesn't last that long. So the point is, whenever you see a lot of overlapping bars, like over here, from the bars 1 through really all the way to 36, it's a warning that something is wrong. And well, actually, let me back up. Whenever you see the first 36 bars going sideways, it's a sign of a neutral market. Both sides are making money. And whenever one side gets trapped, like the rally up to here, it's usually going to lead to higher prices. But then over here, what do you notice? Bears started making money. The bears that sold the 42 high or the 43 high and sold more higher made money. So 21, 22, a second leg down from 20, probably buyers below. Remember, this is a trading range. 24, a strong sell off and reversal. What happened? 21, remember how I said 21 sold off and then traders bought it into the close? Well, in some time frame, 20 is a big sell off and a rally. There are trapped bears that sold somewhere on the 20 low. And what did they do? They sold, and they sold more higher anywhere up here, 21 or the open of 22, somewhere. And what did they do on 24? They bought back the shorts. There's bulls. They know that. So what are they going to do? They're going to buy back shorts as well. So on 24, we have 3 pushes down, 15, 20, and 24, or you can say 18, 20, and 24. Probably going, it might go a little bit lower, but since we're in a trading range, you know the market's probably going to go sideways. 25 outside down. It might be the start of a downside breakout in a measuring gap. So bears, they're thinking about this. They want a double top and a break below the neckline here and a measured move down. And another way to think about it is the bulls have a double bottom, 20 and 24, and then we broke below it. So it's a failed double bottom, which means we could race for a measured move down. 25, a bull bar, tight bear channel from 19 to 25. However, we get a sell off and then a rally, sell off and a doji, another outside down bar and a bull bar. To me, this looks like a trading range. And if it's a trading range, then you know there's probably buyers not far below, and the market is probably going to go more sideways. And then 27, strong bull bar. Reasonable to buy the close of 27, betting on higher prices. Always in bears, get out above 26. Aggressive bulls buy. And then 28, another bull bar. But what do you notice? We have a bull bar that's big on 27 that pauses right at two major resistance levels. Yesterday's low, this blue line, and the moving average, this other blue line right here. So if this is going to be a strong bull trend, why is 27 a big bull bar and then 28 a small bar? Whenever the market hesitates and it's clearly making a lower high, so we have a lower high from 17 and then a lower high right here, you always have to wonder if this is going to be a trap for the bulls, trapping bulls into selling, or trapping bulls into buying too high. It's kind of like the daily chart. I think we're going above the February high, but my concern is, why are we spending so much time below the February high? If the bulls were all that eager to race up above the February high, we would already do it. And if we're not racing above the February high, you know that means something is wrong. 29, another bull bar. So now we have 4 consecutive bull bars, but we had a tight bull channel. Now we had a tight bear channel. Now we have a tight bull channel. You know there's probably sellers above and there's probably buyers below. Therefore, if you're buying the close of 29, you probably need a wide stop. What's wide? Probably somewhere below 25. Because we could fall below 25 or 26 and find buyers and reverse up. So for me, if I'm buying 29, the top of a trading range, I want to buy more at the 26 low, or else I'd rather just wait and see the breakout. 30, a bear bar, and then 31, a big bear bar. So possibly getting a second leg down from the sell off to 25, deep pullback to 29, and then a second leg down. So to me, consecutive bear bars, 30 and 31, but following 4 bars up to 29, probably buyers below scaling and lower. So to me, this is really confusing. Tight bear channel, strong rally, so probably buyers below, and then a little bit of a surprise, 30 and 31, probably going to get at least a small second leg down. And then what happened on 32? We reversed up. So the market made a double bottom with 26 and reversed up fairly strong. Bulls, there will be bulls buying the 29 low. And they bought more lower. And what are they going to do above this bar? They're probably going to buy. So bulls buy above 29. They buy more on the way down. Some just buy more above the bull bar, betting that we test back to this area, 41.60. So always in bears, obviously get out above 32. 33, a decent bull bar closing on its high, probably always in long, but tight trading range. And whenever you see a tight trading range that's contracting, you already know it is some kind of a triangle. So breakout mode, 50-50 chance in general, you get a measured move up. 50-50 chance in general, you get a measured move down. 34, a bull bar, but small body, probably buyers below and going at least a little bit higher. But until there's a breakout, there is no breakout. 35, bear bar, outside down, but probably buyers below. Some bears, they sell the 32 high and scale in. So they're probably going to buy back shorts at the 32 high, which means the 32 high is probably going to be support. 36, a bull bar closing on its high. A little bit of a surprise, testing the high of 30. There might be more sellers up here, but to me, I think a few things. One, I thought it was reasonable, even though it's really high in a trading range, it's reasonable to buy the 18 high and buy more lower. So what does that tell you? That tells you that if you did buy the 18 high, you're disappointed. And in a trading range, usually the market will retest prior signal bars. So you buy the 18 high, you buy more above a bull bar like 26 or 32, and you get out break even on your first entry with a profit on your second. You sell below 4, you sell more below a bear bar, maybe 14, but I mentioned there's problems. It's a tight trading range, maybe below 17 or 19. And look what happened. The market came really close on 20 to the 4 low. And then 36, 37 is important. It's a breakout with follow through. It's not a breakout above the range, but it's a small breakout of this range right here. So you have to wonder if we're going to go for some kind of measured move. So for the Bulls want a measured move up based on a double bottom. They have a double bottom, 26, 32. They want to break above the neckline and a measured move up. And then 36, 37, I mentioned it's consecutive bull bars. And then 38 is a bear bar closing on its low. What about selling below 38? You can, betting on 2 legs up, leg 1 to 17, pull back to 26, leg 2. But to me, lots of bull bars over the past 4 or 5 bars, and we're testing yesterday's 24 low. I'll make this line blue as well. So to me, there might be more buyers below this current bar than sellers. And reversal up on 39. If you did get out below this bear bar, it's reasonable to buy again above 39. It's a high one buy. And if this is going to be a strong rally, it should work. But then 40, a doji, disappointment. Some bears, some bulls might get out below. Other bulls keep their stop below 39. And then we get an inside bar on this bar, and then a breakout bar 42, and then a doji 43. So it's by the close. Where did it start? Where did it become by the close? Some bulls would buy the close of 37, but they'd be disappointed on 38. And I suspect a lot of them would look to sell around the 38 high. Reasonable to buy the close of 41, 3 consecutive bull bars, but you're buying basically a triangle in a tight trading range, and not really that ideal. And then 42, a bigger bar, and then 43, a doji. If I'm buying closes and I see a doji, I'm typically going to exit. 44, bull bar, closing on its high. If you think about it, it's the best looking bull bar of this rally. It's the biggest body with the smallest tail. And you're fairly high in a trading range. You're at a measured move target. You have to wonder if this is a sell vacuum. I know it doesn't look like it, but it's also a wedge. Rally up to 34, pull back, and then a rally up to 38, pull back, and then a rally up to 44. So not really ideal. 45, another big bull bar, and then 46, a doji. So we're getting 1 or 2 bull bars and then a doji, 1 or 2 bull bars and a doji. Probably going to go more sideways to up, but if we start to go sideways, you have to wonder if we're going to get a sell-off or at least a pullback to this area. At a minimum, I think one target for the bears is the midpoint of the day. So here's the high. The midpoint would be the apex of this triangle. High one buy on 47, but probably sellers above. And you can see there were. And then 54, 3 consecutive bear bars, probably buyers below scaling in lower and at least a second leg up. And we got a second leg. But then something interesting happened on 54. 54 is a fairly surprise bar, and it reversed all of 53 and closed below the past 10 or so bars. Strong bear bar, probably buyers below, but 54 is a little bit of a surprise, and it may get a small second leg. And then 55 is follow through. So the bears got minimum follow through, barely closed below the midpoint of this bar. There's probably buyers below, but if the bears start to get 2 or 3 consecutive bear bars, we could easily sell off all the way down to here. It's 2 legs up, leg 1 to 17, pull back, leg 2 to somewhere up here. And when you get a gap down and then 2 legs up, it's a trading range. We sold off to bar 1, we rallied up to 48, big down, big up typically leads to trading ranges. So there's a greater risk of a sell-off. Three consecutive bear bars. Is it sell to close? Might be, but for me, I'd like to see more. And then 57, a doji, and 58, another bear bar, and then 59, another doji. So you're starting to form a tight bear channel, and that's a breakout on a higher time frame. A lot of traders would just start exiting due to the risk of an endless pullback. And then 60, traders giving up, and obviously 61, more traders giving up. So all the bulls that bought and bought more lower are clearly getting squeezed out of the market. So it's sell to close 60, sell to close 61, sell to close 62, becoming climactic, but probably the first reversal up will fail and at least lead to a second leg down. Still sell to close 63, but at the open of the day, doji 64, and we got a second leg down. So there were sellers above 65 and 66. Because of this rally, though, and how climactic it is, especially with it being at the end of the day after all this buying pressure, you know there's probably buyers below scaling in lower, which is in part why this happened. So for me, I think it's reasonable to sell 60, 61, 62. You don't have to get out here. If anything, bears are selling, scaling in. Then you get a second leg. I'd be pretty quick to exit shorts here because the risk is sorry about that. The risk is we get up to 67 high, which is the top of the most recent sell climax. By the way, I'm going to answer questions in a few. So depending on how many questions there are, is depending on how many I'll answer. Stop entries, reasonable to buy above one, but for the reasons I mentioned earlier, it's not ideal. Better to wait for consecutive bull bars, and really better to wait for a micro double bottom. Whenever you get a big gap down and bar one is a bull bar, it's a reversal of the gap, and typically gaps lead to sideways trading and lower probability that you get a trend from the open. So reasonable to buy above one. Would I buy above 7? I would not. And reasonable to sell below 19, second entry short, or 17. If I sell below 17, would I get out above 18? I would not. I'd keep my stop above 17. And I'd certainly get out of shorts above 26. Aggressive bulls can buy, but tight bear channel, probably at least a small second leg down. You can sell below 30, but if you do, after this many bull bars and the market reverses up here, it's probably in a trading range. So bears exit above 32, aggressive bulls buy. And in here, you can buy above any bar. You can buy above 39, not easy, but it's reasonable. And the next stop entry is probably selling below 60, 61. You can sell below 67, but big outside down bar, probably not going much lower. So you have to be quick to make decisions. And for me, I'd just let the rest go. For limit orders, the whole day was really limit order trading, except for really 36 to maybe bar 66, somewhere in there. Reasonable to buy below bars on the way down to 6. Reasonable to sell above 7 or 8. Excuse me. It's reasonable to sell above 7, but to me, I would not. I think that the bulls have a credible shot at getting a second leg up from 1 to 4. So to me, I'd rather look to sell somewhere up here. Bulls, I thought it was reasonable to buy below. I say that. I was going to say it's reasonable to buy below 10, but it doesn't look like it triggered, and it did not. And for the bears, you can sell above 13, but a little bit of aggressive, but it's reasonable. And buying below 34 makes sense. And then over here, you can sell below any bar, but the first sell that triggers is one of these highs. Buy the close, sell the close. Probably buy the close 3, but you need a very wide stop, and you probably need to be able to buy more at the one low. And if you can't do that, most traders would wait. Buy the close of 9, reasonable to double bottom with 1 and 7, so probably going to go at least a little bit higher. Buy the close 33, buy the close 36, buy the close 37, and then probably buy the close 41, 42, and I'd probably stop buying after 42. whenever you see a doji, typically it's better just to wait. Sell the close 55, 56, and then definitely maybe sell the close 55 and 56. That's pretty aggressive. Definitely sell the close 60, 61, 62, 63, betting on a second leg down. And I'd let the rest of this go. Let me take a look at a few questions. Someone asked, where do traders usually break even at 50% pullbacks? Can you give an example? Yeah, so that is pretty common in trading ranges. So bulls buy the close of 3, and no, let me give a better example than that. So let's say you sell below 4 right here, and you sell more below a bear bar. Let's say below 17. Some traders that sell here and below 17 are going to be so disappointed on the trade that they will look to get out break even, which would be in here. Other traders will hold, so they can do it kind of two ways. One, and in this case, obviously you would have gotten out at your original entry, but let me do a different, try to show a better example. Here's one. So let's say you sell below 4 and you sell more above a bull bar like 4 during 9, and you can see what happened on 10. The market sold off and almost came to break even but didn't, and then it rallied. A lot of traders, when that happens, they will raise their prices. So in other words, they sell below 4, they sell more above a bar, they try to get out break even on 11, on 10, and then when 10 reverses up, they raise their price and try to take a little bit smaller of a loss and exit on 11. But break even trades they're really common. And the difference on the open here for the first 33 bars is break even trades are generally very forgiving, or trading ranges are generally very forgiving in for scaling in with limit orders. So you can buy here the 18 low, buy more lower or below a bull or above a bull bar like 26 and make money. I think that's one of the single most important things traders have to realize. Trading ranges are very forgiving for limit order traders. And you can see here a little bit different. The bears that sold and just scaled in all the way up, they probably lost money. They might have broken even here. So if you want to see to this person's question about 50% trades, here's an easy one. Let's say you buy the 11 low. So you buy the 11 low and you wait and buy more above a bull bar. And your logic for the 11 low was it's a parabolic wedge, 1, 7, and then you're betting that the new low of the day will lead to a wedge and will reverse up. It's not ideal to buy below 7, to buy below 11. But if you did and you bought more above a bull bar, you got out break even right here. Let me take a look at some more questions. Okay, question, is there any point in thinking of 32 through 45 as a breakout and micro trend on a higher time frame? Yeah, no, that's absolutely what you should think. It's important to understand the bars are fractal, markets are fractal, which means that a tight channel on this time frame is a breakout on a higher time frame. A tight channel going down is a breakout on a higher time frame. And I want to actually show that. Let me just pull up one thing. Give me 1 second. Almost got what I'm looking for. Share my screen really quick. So you can see right here, this is an example. It's a slide I made of a small pullback bear trend. And you can see here's the 60-minute chart of that sell-off. Here's the 15-minute chart of that sell-off. And the whole point behind it is small pullback trends create strong breakouts. So it's very important to understand what the next time frame looks like. Here's another one. And here's a strong sell-off on a 5-minute chart, which is right here. This is a 1-minute chart of that same sell-off. And the point is, you have to learn to recognize that small pullback trends are typically going to be, switch this back over, small pullback trends are always breakouts on higher time frames. Why not sell below 54? Higher high major trend reversal and a wedge. 45, 49, and 53. So 45, 49, 53. Yeah, it's not unreasonable. So we have a gap down, decent. Let me do it like this, actually. There we go. So we have a strong rally, trend line break, and a new high. And to me, it is a higher high major trend reversal. It's probably going to be minor and lead to more sideways. In this case, it led to an endless pullback, but it tested the lows over here and found resistance. So because of this big sell-off and this big rally, whenever you have a gap down or a sell-off, and the sell-off could be the high of yesterday to the low of bar one, and you get two legs and you get a rally that looks strong, but it has its own problems. Whenever you see that, you always have to wonder if that is going to be a minor reversal. In other words, be a lower high in a bear trend. You never know how many dollars are just waiting to sell. So yeah, you sell below 54, you put your stop above the 53 high. And by the way, while I'm answering these questions, I'd be very interested to know what would be if I was going to make a video over some talking points, such as maybe things in the trading course or just questions you have. I'd be very interested to know what those are. So please share some comments as far as, if I was going to talk about something for 20 minutes, if there was a certain, particular subject to trading, what would that be? I'd be very interested to know that. Okay, so can you go over Monday's open and comment on looking for a swing in management? Sure. So as you know, let me see what Monday, I know it's 17th. As you know, I typically say all the time on the blogs that most traders should wait for the swing to develop. So look for a swing trade on the open. And the reason for that is the first 6 bars give you an incredible amount of information. So if we go back to today, what did I say about the first 3 bars of the day? I said that because of the first 3 bars, the day was either going to be a bull trend or a trading range day and not an unlikely to be a bear trend day. So that's the first thing I would make comment about the open. The second one is I want to see what the first 6 bars look like. If there's a lot of overlap, I'm expecting a trading range. Next, I want to look for double tops and double bottoms and wedge tops and wedge bottoms because one of those patterns will often lead to a swing trade. And on the open, you typically get a swing trade that begins at least before the end of the second hour, and there's a 40% chance that that swing will lead to a trend, or not a trend. It will double the range. So 12, you can argue maybe it's 3 pushes up, 1, 2, 3. It's not ideal, but 40% chance 12 will double the range. So in other words, we get a measured move from the high of 12 to the low of 1 down to here. So for me, if I'm trading Monday and I'm looking at this chart, the first thing I'm looking at is we have 3 bull bars, probably buyers below 3, big bar. So now we have a big rally and a big sell off. I know there's probably buyers below 3 and below 1. And when I look at 4, I'm disappointed. So I know that there's bulls that bought 3, they scaled in lower. If I'm a bull that bought 3 and scaled in lower, I'm disappointed. And I'm probably looking to get out around the 3 low. And you can see all those traders that bought and scaled in lower here and bought more on 4 made money. So it's a limit order market. It's better to be doing the opposite of what the bars look like. If it's a bull bar, sell it. If it's a bear bar, buy it. 6 broke below 5 and turned up, and bulls made money. But look at the bars. Terrible stop entry bars. So I'm in trading range mode, scalping, sell above bars, buy below bars, and I know this range is going to increase in size. And then 7 broke to the upside, so it triggered a buy and immediately sold off. That trapped bulls. You had some bulls that bought on 2 and bought on 3. They scaled in lower. And what did they do on 7? They started selling out of longs. 7, bear bar, closing on its low. Reasonable to sell below the bar. But if you're selling below 7, you're selling in a tight trading range. And it is a double top with 3 and 7, but forcing you to sell at the bottom of the range. Most traders are better off waiting. Wait for a strong breakout. And that's why that happened. Traders that did sell below 7, look what happened on 9. They were disappointed on 9. They got out break even. They were disappointed on 7. So they sold below 7, disappointed on 8. If I sold below 7, a big bar, so bad risk reward with low probability, it's weak math. I'm going to be extremely quick to get out if the entry bar is poor. And when this bar right here closes a doji, I'm looking to get out at break even. And then 9, 10, and 11, 3 consecutive bull bars. But if you're buying the 11 close, it's kind of like selling the 7 low. If the follow through is bad, traders get out. And it's a possible third push up. 1, 2, 3. So when I see a bar like 12, the way to think about it is when you have a trading range open, traders are constantly getting disappointed. They buy low, they sell low and they're disappointed, so they quickly get out. They buy high and they're disappointed, so they quickly get out. You can think about 9, 10, and 11 as momentum buying. But then as soon as we get to the high of a trading range, the momentum stalls and reverses. You get a big sell-off like this bar right here, bar 4. And as soon as it closes, the momentum turns off. That's very different than this bar right here. This big bear bar was very big. It's going to lead to lower prices. Here, this was a little bit lower probability of a day. But when you rally, bar 1 and 2, good buying pressure. Then 3 and 4, still good. But you get a doji, another doji, and then you get this big sell-off that rallied and formed a doji. Well, you're going to have bulls that bought in here disappointed by this sell-off. And what are they going to do on this doji? They're going to exit. Why would they exit? Because if I'm a bull, if I'm buying the close of something, I want the market to race and go my way very quick. If it doesn't go my way, that tells me that something is wrong with the trade. So for me, on this kind of day, I am expecting a lot of trading range trading. And, that's just, if you're trading with limit orders, you're going to do fine. You get a big bar like this bar 14, you sell the close and you scalp out for a couple points lower, you'll make money. But if you wait until 15 closes and you're slow to exit, then it's going to make it more difficult. So really, the management, what I would do if I'm selling, I mean, in general, in any day, I'm willing to scale in. So if I'm selling the close of 14, I'm generally scalping out, and if I'm still short, I'm scaling in higher, betting on a second leg. So in general, when you have a breakout like 14 or 15, you're almost always going to get a second leg. It's just in a trading range, that second leg is delayed for 7 or 8 bars sometimes. So we had a sell off down to 15 sideways. That's the delay or the pullback. And then a second leg down. Strong sell off 24, 25, 26. Possible second leg trap. We go sideways for several bars. We tried to rally, but then we got a second leg down. And that might be a good topic one day to discuss later. Sandro asks, I have quit some discussions with other traders about scaling into a losing position. Some are against it, but it serves me well. What are your personal opinion about scaling into a losing position? I think a lot of traders scale in for various reasons all the time. And, you know, I know there, yes, there are some traders who don't scale in and will not scale into losing positions. And that's okay. But in general, the logic behind saying that I'm not going to scale in because it's a losing, it's not a smart thing to do. That's flawed thinking. And you only say that because one does not understand how to read a chart. So to me, I think scaling in is fine as long as one can read the chart correctly. Looking over some questions right now. Someone asked, did I take a trade and it didn't work out? Yeah, that happens all the time. And, for example, I bought in here and had to get out somewhere down here. So it took a little bit of a loss. And, in general, or for example, happened to me on Friday. I was long up here. I was too slow to get out and had to sell out down here for a loss. And I was betting on a second leg up. In general, when you're scaling in, you have to be faster. If you're scaling in with limit orders, you're going to do pretty well most of the time. You buy below bars, you scale in, you get out. You buy the close, you maybe scale in, you get out. I sold below this bar, sold more somewhere up here, had a wide stop, got out on the way down here. You can buy below bars, scale in, get out, buy below here, scale in, get out. But and it you're going to have high probability, but you have to know how to manage the trades like this that go against you. Do you normally enter a trade on a 5 minute, and after you enter, do you watch a higher time frame or do you stay on the 5 minute? I'll generally stay on the time frame that I'm trading. So for example, there's sometimes I'll go to a 1 minute chart. I think I did it. I did it somewhere over here. Maybe it's 27. So sometimes I'll look at a 1 minute chart and it's in here. I think it was. Let me just see. I can't remember where it was. But, sometimes I will. For example, if it's late in the day, Sometimes I might buy a close, like a breakout with follow through, buy this close for a scalp. But to me, that's pretty aggressive. In general, most traders should just wait for trade the one time frame they're trading and don't switch back and forth. That's the easiest way. Okay, so relying on stops versus exiting early because you believe your stop is probably going to be hit. Yeah, let me just bring up a spreadsheet because I think that's a fun topic to talk about. And this is something that we could all think a lot about, and it's super important. Let me just see here. I've got to download it really quick, but I have it on my computer. There we go. So let's talk about that for a second. Give me 1 second. I'm going to load this on my computer. Let's see here. There we go. Just give it a few more seconds here. Of course, I'm trying to bring it up and it is not populating. I'll move on to a question, but I'm going to come back to that because I really want to show that probability spreadsheet. So let me just, but I can do this though. Hang on. Yeah, I'll come back to it. Just give me one more second here. There we go. Okay, so now I'm going to pull up this spreadsheet. And again, I apologize for taking so long, but I think this is just something that is extremely valuable to think about. But unfortunately, every time I try and share the workbook, it keeps crashing. Okay, I'll come back to it. So, but in general, the whole point behind that is whenever you are, here we go. Great. So let me give an example. Whenever you are in a trade and you buy, let's say, let's pick a bar, buy the close at 9 and your stop's below 8. In general, it makes a lot of sense. But you can only take that trade if you think the probability is 60% that you're going to get a 1-to-1 risk reward. And whenever you buy and you put a stop somewhere down here, your probability is bad. It's a 1-to-1 risk reward. And your risk reward's bad. Your probability is high, risk reward is bad. And the problem with that is the second your probability becomes less than 60%, it's a losing trade. Now, I want to share this workbook. I've shared this many times in the trading room and just at various videos. So let me see here. Okay. Here is a well, do this. That works. Okay. I took a screenshot of it. Again, I don't have no idea. I've never had Excel be that difficult on me, especially on this computer. But anyways, we have a table right here. And this table represents basically probabilities. So the probability of going for a reward that is 1 times your risk, 1-to-1, and your probability is 60%. That is very marginal trading. And that's very similar to buying the close of a breakout bar, using a wide stop, betting on a measured move, or going for 1 times your risk. Here, this is going for twice your risk. And the key point I'm trying to make is when you are taking this trade right here, where your risk reward is 1, your reward is 1, risk is 1, and your probability is 60%, that is break even almost. You really need to be in the 70% probability, which means you have to be if your risk reward's 1, you've got to be very quick to know when to exit the trade, because you cannot let your stop get hit. It will get hit at times, but you have to exit. In other words, you have to exit before your stop gets hit. If you're going for twice your risk and your probability is 40% and your risk is 1, your reward's 2, twice your risk, this is much easier to become consistent with, because if you can get better at getting out of trades, you can probably increase your probability closer to 45%, and 45% nearly doubles what you make. So I'll talk more about that later, but you cannot let those kind of stops get hit if you're risking 1-to-1. Yes, this will be posted later. I will make a separate video on the spreadsheet. Okay, question. I took a trade and have a positive trade. I took a trade and made money, but as the day goes on, I get eager to trade more. Currently, I'm undercapitalized, and because of this mindset, it's making me lose a lot more what solution is this? Or what should I do? Yeah, so the person's asking a really good question and a very valid one. What they're saying is they're taking a trade, they take a trade and they do well, and they want to make more, but they're also undercapitalized. So there's two I think there's two problems with that. First one, let's talk about the undercapitalized piece. One is you cannot risk too much per you have to be careful with how much you're risking per your account. In general, most traders should not risk more than 1% of their account because if they do, they're going to lose money. The other problem is if you're undercapitalized, you're generally going to do things that are more aggressive than they should be. And what that's going to do is it is inevitably going to cause you to lose money. So for most traders, I wouldn't. If you're undercapitalized, I would find a way I would trade Forex, trade something personally, until you can trade 3 micros, I think most traders should avoid trading the micros. And why I say that, because they need to be able to trade very, very small and very comfortable. So that'd be the first thing. And the second one is it's easy to be eager. Generally, the better you get at trading, then it becomes easier to not be as aggressive and be more cautious. But overall, trade things like Forex. But I would find a way to trade smaller, because if you trade too large, you'll end up carrying. And if you end up carrying, you will begin to lose more and more money. Okay. Do I ever trade options? I do not. I plan on trading options down the road, but right now I currently do not, but I do pay attention to them. Okay, that's all the time I have, and I'm going to take a look at some of these questions, and I hope to make videos over them soon. Okay, hope everyone takes care and everyone have a good one.